Okay, so I'm just going to talk about why gold prices went up and down today in the market. I'm gonna talk about some of the reasons why that why these fluctuations happened. So to begin with, um, we have the Red Book year on year index, which was released today. Um, Basically, the Red Book index is a sales weighted over year same store sales growth in a sample of large US general merchandise retailers representing about 9,000 stores. Now, normally a higher than expected number should be taken as a positive sign for the US dollar and for the economy, while a lower than expected number, especially a negative one, can be seen as a bad sign for the dollar and for the economy. Now, it was announced today that the store sales growth was 4.6%, which was lower than the previous amount, the previously reported amount, which was 5%. So that's a loss of 0.4%. Obviously, this indicates that since the figure is still positive, it's not a negative number. That means that's a good sign for the economy and for the dollar. But still, it is a slight downgrade, of course. But nevertheless, because this is good news for the economy, naturally, gold prices started to fall here by a lot. So very sharp decline. Now afterwards, then we got the news from the US S&P Global Composite PMI, which is the Purchasing Managers Index. Now, PMI is a leading indicator of economic activity, and basically it represents the rate of expansion or contraction of a specific sector, such as manufacturing, services, or construction. And essentially, the way it works is if the PMI is 50, that means that there was no change from the previous month. If the PMI is above 50, that indicates that the economy is expanding. And PMI below 50 indicates that the economy is contracting. So the actual figure that was released was 46.6, which is of course below 50, which indicates that the economy is actually contracting. And this is of course really bad news for the US dollar and for the US economy. And naturally, the gold price started to increase really sharply again. Additionally, around the same time, um, the US Richmond Services Index was also released, and this is an index which surveys 5th District manufacturing activity, business activity in those specific districts. Um, yeah, basically all firms surveyed are actually located within the 5th Federal Reserve District, and each index equals the percentage reporting increase minus the percentage reporting decrease. Now, it was reported that the manufacturing activity has improved from minus 12, which was the previous figure, the previously reported figure, to minus 6, which is good news. It's very good news indeed, that means the manufacturing sector is starting to see an increase in activity. Nevertheless, the figure is still below zero though, and that means manufacturing is contracting. But nevertheless, the market saw this as good news. Obviously, it went from -12 to -6, so it improved by 50%, you could say. Um, Afterwards, then we got the news. We got the US 52-week bill auction released. What that is, it is this basically indicates the government debt situation in reference to the bill yield. So if the bill yield increases, that means the debt situation is worsening, and if bill yields are falling, debt situation is improving. Now the actual reported figure was 4.46%, which was lower compared to the previously reported figure of 4.515%, which means government debt situation is improving, and this of course is good news for the economy and the dollar, but bad news for gold, of course. And as a result, gold prices actually started to fall, as we can see here. Then the US 2-year note auction was released. Now this is very similar to the 52-week bill auction. The only difference is the time period, and it was reported that the bill yield for 2-year bonds, 2-year bills, decreased to 4.139% from 4.373% previously. So this of course indicates the opposite. This indicates that the debt situation might be improving. So this is good news for the economy. And of course, the gold prices did fall a bit. I mean, it did take some steam off, as we can see here, from this a bit of boom that we got going on there. And lastly, there was the US API weekly crude stock released. So this indicator basically gives you an overview of US petroleum demand. Basically, if the increase in crude inventories is more than expected, it implies weaker demand and is bearish for crude prices. The same can be said if a decline in inventories is less than expected. If the increase in crude is less than expected, it implies greater demand and it's a bullish sign for crude prices. The same can be said if a decline in inventories is more than expected. The forecasted stock figure for January 24th was 1.6 million barrels, but the actual crude stock was roughly 3.4 million barrels, indicating weak demand for crude, so lower crude prices. And of course, how does this relate to gold? I mean, this is mostly about oil, right? Well, the thing is, gold and crude oil have a positive relationship. That is to say, when one falls, the other does too, and vice versa. When one rises, the other one also rises. Now in this case, it was the former. Since crude oil prices are falling, then gold prices are also likely to fall, because obviously, because of that positive relationship, and we can see the price of gold actually decreasing here as well. And then here, and then it starts to go back up again, then falls very sharply again. So I think here it's mostly this is the work of speculators and just natural supply and demand forces in the market. I think a lot of people wanted to basically, a lot of traders, regardless of who they are, they put a lot of put a lot no they put a lot of buy orders around $1,936 or somewhere around here, and then they decided to just take their profits and just get out. And then here we got a lot of a lot of sell orders, and then the price started to crash. Yeah, so it will be interesting to see what will happen to the gold price tomorrow, whether this trend will continue or it will go back up again.